Byrne, Gary Walsh, Brenda Wheatley, and Carol Donnelly. Joseph Byrne and Gary Walsh will be the presenters today. Right now I'd like to turn the call over to Joe and Gary, who will begin the presentation.
Great, thank you, Carol. Today is August 27th, and let's start off with a couple of brain teasers. What was the annualized total return of the S&P 500 index in the 1930s? 0%. 1930s was the Great Depression, and if you think back, times were terrible. Over that 10-year period, there was actually a 0% return. But subsequently after that, 1940s, that 10-year period, the return was 9% per year. 1950s, it was 19% per year. Another brain teaser. The bull market of the 1980s and 1990s produced an average return of what? Answer is C. The 1980s produced an average return of 17.5%. 1990s produced an average return of 18.2%. 2000 decade looks like we're experiencing something that happened in the 1930s, and we're getting towards the end of that decade right now. So where are we so far this year? June 30th, 2009, our NASDAQ composite is up 16.4%. Comparably, in 2008, the NASDAQ was down 40.5%. The Dow Jones was down 33.8% in 2008. Right now, as of June 30th, it was down 3.8%, whereas today, the Dow Jones is actually up 9.2%, and the NASDAQ is up 28.5%. So you're seeing since June 30th, we're continuing to have a good run in the market. The other thing that stands out here is oil. For 2008, the price of oil dropped 53.5%. Year to date through June 30th, oil was up 57%. And as of today, oil is up 62.8%. So what did the professionals say about what they anticipate is going to happen in 2009? Dr. David Kelly from JP Morgan Funds predicts the market's going to be up 27.3%. Gary Schilling, down 22.5%. The average economist that studies the S&P 500 has predicted that the market will end at 1,020, which is a change of 12.9% through the end of 2008, whereas currently we are up 14.2%. So some indexes that we measure. The Business Week has a consensus of indexes, and they're looking at operating profits being down 7.5%, CPI inflation down, actually up 1.2%, whereas year to date, year over year, CPI is actually down. And what that means is the cost of goods has actually dropped year over year. Fed funds rate is pretty much 0 to 25 basis points. Jobless rate, 8.1%. Home price change, down 9.8%. Jobless rate is actually at 9.4%, and it was at 9.5% June month end. It's actually dropped a little bit in the month of July, but I anticipate that the jobless rate is going to peak out at 10.5%. GDP fell at 5.5% annual rate through June 30th in the first quarter, which follows a 6.2% plunge in the fourth quarter. And GDP is continuing to fall. Earnings for S&P 500 companies actually are at a drop of 14.2% through 2009. The recession has certainly taken a toll on corporate earnings in 2008, and 2009 is showing that. The good news about this is earnings year over year comparison, because it was so bad in 2008, is going to compare better in 2009 as we go forward. CPI inflation declined 1.3% for 12 months ending May 2009, and we are certainly in a deflationary period. Through July, CPI is down 2.7%, and that is the cost of goods to the American consumer is actually dropping, which is good news and bad news. The fact that cost of goods is dropping is a good thing, but that also means that we're not spending enough and the economy is not moving forward as we expect it to. Interest rates are very low. Government bonds were weak. Riskier bonds were strong with the interest rates associated with that. But this is actually a good time to refinance because rates are as low as we've seen in a long time. Jobless rate, 9.5%. And the recession actually started in December 2007. Number of unemployed persons has risen by 7.2 million over that period of time. Home prices, although Business Week projected at the beginning of the year we would be down 9.8%, we're actually down almost double that at 18.1%. This is one of the largest and deepest recessions on history, and the housing market is typically one of the ones that gets hit the hardest. And what we're starting to see now is the housing market's settling, which is another good sign for the economy. Commodities can also be a leading indicator of economic growth, with gold, silver, copper, and oil up and down continuously, but more up than down. So the economic stimulus came out, and right now we're only seeing about 10% of the first round being spent. As a matter of fact, the other day I read in the paper that the loans that have gone out to the banks has generated $18 billion of interest repayment back to the government compared to $7 billion that they would have normally made by loaning out the money. Right now they're calling for a second round of economic stimulus. I believe that's not going to happen because they've only spent 10% of the first round, and they're starting to get some of those loans back from some of the bigger banks that were in trouble last year. Cash for clunkers resulted in around $700,000 of cars sold. A real stimulus. And that was $700,000 of cars being sold. Consumer spending is very weak. Right now we are at a 15-year high in terms of savings rate, but that also means that the economy is not going forward because spending is slowing down. Right now I'd like to turn it over to Gary Walsh.
So let's take a look now. Are these huge price swings that we've been seeing in the markets over the past year normal? So in order to review that, let's go back and look at some past bubbles. For instance, 1921, the market rose just under 500%. That was followed by a plunge of 89% in less than 3 years. The Nikkei back in 1984 rose over 300% and then plunged 82% over the next 19 years. As you can see, it was a long, protracted decline for the Nikkei. The Nasdaq back in 1998 and 2000 rose over 300% and then followed that with a plunge of over 80%. The Shanghai Index, which rose 500% between June 05 and October 07, it then reversed and fell 72% over the next 13 months. Some of the things that we have might not be all that familiar with would be sugar prices, which back in 1966, between 66 and 74, rose over 4,000%. but then followed 4 years of a decline of 80 some odd percent. Oil prices. Back in 2001, between 2001 and 2008, rose over 700%. We're all too familiar with that. $4 a gallon of gas. And then followed that up with a drop of over 76%. It's been one of the more volatile commodities in our economy, and it continues to be.
Incidentally, the price of a gallon of gas over the last year has actually dropped $1.10 per gallon.
So, what we can take is that bubbles form, they pop. They're all part of the cycle. It's our greed, fear, it's our human behavior. Markets don't always trend up in a nice steady line. Instead, they move all over the place, and at times they rise much faster than you expect, and then they also drop much lower than you might expect. So, hence, we look at this. The cycle of an investor's emotions. You go from optimism to euphoria to depression to optimism. And at the point of euphoria is the maximum point of financial risk. Because this is when everybody feels that it's the best. The market's doing well, their portfolios are doing well, the economy's doing well, everything is clicking just perfectly. That's when everybody should be backing out. Conversely, at a low point in the depression stage, that is when the maximum point of opportunity. This is when we should be fully invested. So for us, what we try and do is we try and monitor and work with you to keep you invested through these good times and bad times, less invested at what we consider the risky times, more invested when we feel the best opportunity is available. So, let's take a look at some of these bear markets. And let's try and put them in context. For instance, this chart can be confusing, but if you look at it, you got the crash of the Dow Jones, which is signified by the gray line, back in 1929. Over a period of 4 years, it fell some 89%. And it took just under 3 years. You go back to the period when the oil crisis, which was represented in a red line, and that was over, just under a 2-year period, 20 months, and the S&P 500 fell over 48% at that time. The technology crash, or what we would consider the tech bubble back in 2000, 2002, this period of time lasted about 30 months, and it too was down 49%. And the current environment, our current bear, we'll say, which began back in October '07, and so far it's running 22 months. And at the worst point of this, we were down 56%. But recently, in the last 3 months, we've recouped a dramatic amount, up over 30% in the last 3 months, to a point where now we're only down 42%.
And actually through August 27th, we're up over 55% from the low. The other things that I want to point out on this graph is that what you see is when we've hit the bottom, it's not a straight up. It's an up and down volatile curve, but you typically have the biggest rebound opportunity when the market hits the bottom. The last point that I'll add on this is markets have always hit new highs. And we're a long way from that right now. I think over the next couple of years we will definitely get through a new high.
So, Russell Napier wrote a book, The Anatomy of a Bear. And there's a couple lessons that we can take from this. And basically, of all the commodities, the change in the trend of price of copper has been one of the more accurate signs leading to better equity prices. Currently, copper has risen dramatically over the last few months, and right now that poses a very positive sign for us. He also states that the birth of a new bull market for corporate bonds will precede the end of a bear market in equities. Corporate bonds have also risen significantly in the last few months, and that also is a positive sign. So as more people are putting money into the corporate bonds, which is a little more risky than treasuries, but it's based off of corporate earnings, people are starting to feel a little more comfortable about the market. Bear market bottoms are usually characterized by an increasing supply of good economic news being ignored by the markets. The decline in reported earnings will continue well past the bottom of the market. And currently, investors may have to get to that point of disgusted feelings or just feeling depressed with the markets before they'll bounce back in. And it's not uncommon for a market to rebound before corporate earnings do. And I think that's what we're starting to see here. People were about ready to throw the towel in back in February and March, and all of a sudden the market started to get a little bit better, and they started to get a little more positive feeling, and people are starting to get back into the markets, and that's why we're starting to see a turn. Also, corporate earnings are starting to get better. Another sign that a bottom has been reached is you'll see a decline in markets on low volumes. And when the markets go up, it'll be on high volumes. And when this happens, it suggests that selling pressure is basically ended and that investors are ready to get back in the market, and they take every little dip as a chance to pile in a little bit more aggressively. Some things that we watch here. These are 10 items that we pay close attention to, which help us develop a strategy. And there's, great significance to various different ones, but a couple that I'll point out is the S&P earnings yield, which is one which we put a little extra weight on. And this is, the S&P earnings yield is basically, you take the earnings, the average earnings of the S&P index, and you divide it by the index, and you come up with a number. In this case, it's 5.9%. And you divide that by the 2-year Treasury. You divide that by the 10-year Treasury, and this gives you a number which is either more than the Treasury yield or less. And if it's more, then stocks would be considered a positive place to be. If it's less, then it's better to stay out of the stocks. Another thing is mutual fund cash, and it's a hard category to value and to monitor. We watch it because it's an important factor with how much cash is on the sidelines. And currently, there's a huge level of cash, as everybody would consider a huge level. But currently it's like 4.6%. But let's go back. Now let's just take a look at cash versus the way the markets have acted. Major rallies have occurred in the stock market back in 1974, 82, and 1990. And those corresponded with cash levels held by mutual funds of greater than 11%. Conversely, the market has sold off in 1973, 76, and 2000 when cash levels were below 4.5%. Now, as I said, cash levels this year, back in February they were at 5.9%, then they flipped over, and in April they were 5.1%, and in May they were 4.8%, and in June they're 4.6%. This would signify, a market that might be overvalued, that there's not enough cash to sustain a buying trend. But in our view, a lot of these other sectors are overweighting this, and that's why we still think this is a good place to be.
History does not repeat itself exactly, but behavior does. We showed you the emotional graph before. We believe we're at the bottom of the cycle, the depression, everybody throwing the towel in. So we think that it's a good time to be in the market and looking forward. We also agree that the market is going to be rocky, going to be volatile, and we think we saw the bottom in March, and we're going to, over the next couple of years, be higher rather than lower. And right now I'd like to just thank you for listening to our presentation, and Gary and I being in this business for over 55 years combined. We're here to help if you need it. Thank you.